Capital increase in stock companies is a strategic move that involves issuing new shares or raising the nominal value of existing shares to secure additional funding. This mechanism offers several advantages. It enhances financial flexibility, allowing companies to access more funds for expansion, research and development, or other strategic investments. By increasing capital, companies can undertake new projects, enter new markets, or upgrade their technology, which can be crucial for staying competitive in a rapidly evolving business landscape. A capital increase can also help reduce a company's debt burden by replacing high-interest debt with equity, thus improving financial stability. This shift can lower interest expenses and improve cash flow, enabling the company to invest more in growth initiatives. Successfully raising capital signals to the market and investors that the company is in a growth phase, potentially boosting its stock price. This positive market perception can attract more investors, increasing the company's market capitalization and overall valuation. Moreover, additional capital strengthens the company's balance sheet, making it more resilient to economic downturns and financial crises. A strong balance sheet can enhance the company's credit rating, making it easier and cheaper to borrow funds in the future. For existing shareholders, a capital increase can present an opportunity to purchase new shares at a discount, which can be beneficial if the company's prospects are strong. This opportunity is often provided through rights issues, where current shareholders are given the right to buy new shares at a price below the market value, protecting them from dilution and giving them a chance to maintain their ownership percentage. However, there are also significant disadvantages associated with capital increase. Issuing new shares dilutes the ownership percentage of existing shareholders, potentially reducing their control and influence in the company. This dilution can be particularly concerning for large shareholders who have a significant say in company decisions. Frequent capital increases can be perceived negatively by the market, suggesting that the company is unable to generate sufficient cash flow from its operations. Such a perception can lead to a decline in the stock price as investors lose confidence in the company's management and financial health. The process and regulations governing capital increase can differ widely from one jurisdiction to another, influenced by local corporate laws, market conditions, and regulatory frameworks. For example, in the United States, the process typically involves board approval, filing with Securities and Exchange Commission, shareholder approval, often via proxy vote, and compliance with various federal and state securities law. In Turkey, the process for capital increase also involves several key steps governed by the Turkish Commercial Code. The process generally starts with the preparation of a capital increase plan by the board of directors. This plan must be approved by the shareholders in a General Assembly meeting. Once approved, the company must file the necessary documentation with the trade registry, including a detailed prospectus that outlines the purpose of the capital increase, the amount to be raised, and the potential risks involved. The trade registry reviews the submission to ensure compliance with Turkish laws and regulations. Additionally, in Turkey, there are specific provisions to protect the rights of minority shareholders during a capital increase. For instance, existing shareholders typically have preemptive rights, allowing them to purchase new shares in proportion to their existing holdings, thus preventing undue dilution of their ownership stake. Turkish system also emphasizes transparency and full disclosure, requiring companies to provide comprehensive information to shareholders and the market, ensuring that all stakeholders are well informed about the capital increase and its implications. Comparing different jurisdictions, it is evident while the fundamental principles of capital increase, such as board and shareholder approval and regulatory compliance, are common, the specific procedures and requirements can vary significantly. Each country's regulatory framework is designed to balance the need for companies to raise capital efficiently with the need to protect investors and ensure market integrity. Consider the case of Company X, operating under a jurisdiction with strict corporate governance laws, which decided to increase its capital to finance an ambitious expansion project. However, the board did not fully disclose the risks associated with the project to the shareholders. Instead, they presented overly optimistic projections, which led to the approval of the capital increase. Post-increase, it became evident that the expansion project was not as viable as initially presented, resulting in substantial financial losses. Shareholders alleged that the board acted in a bad faith by withholding critical information and filed a lawsuit. The court found that the board had indeed breached the fiduciary duty and the principle of good faith, leading to significant penalties and a mandate for stricter oversight in future capital raising activities. The misuse of the capital increase mechanism can manifest in several ways. Companies might overstate prospects to secure shareholder approval, knowing that actual use of funds is high risk or misrepresented. The deception can lead to shareholder mistrust and legal actions once the true state of affairs is revealed. Insiders might exploit their knowledge of an impending capital increase to engage in the insider trading, undermining market fairness. Such actions can result in severe penalties and damage to the company's reputation. Additionally, raised capital might be diverted to projects that benefit insiders rather than the company or its shareholders, such as overpaying for acquisitions from related parties. These conflicts of interest can erode shareholder value and lead to regulatory scrutiny. While capital increase is a powerful tool for stock companies to secure additional funds and drive growth, it must be executed with transparency and integrity. Jurisdictional regulations play a crucial role in governing this process, and misuse can lead to severe legal and financial repercussions. Companies must adhere to the principle of good faith, ensuring that all actions taken during a capital increase are in the best interests of the shareholders and the company. Transparency, proper disclosures, and adherence to regulatory standards are essential to maintain investor trust and ensure the ethical use of the capital raised. Thank you for listening.